Last week, the S&P 500 closed at record highs, and we see some very strong performances right across the board. When we take a look at market sentiment, right now we are sitting firmly within greed, although we do note just a week ago it was within neutral, and this can change very quickly one way or another. Now in today's episode, we are covering 8 undervalued dividend stocks for long-term massive gain. As always, we'll cover their historical performance, we'll look at their earnings expectation moving forwards, we'll cover how they've performed over the last 4 quarters, we're going to touch upon their dividend safety, very important. Some of these companies have some very high yields of even over 6%. We'll also talk about another way of looking at undervaluation through dividend yield theory, looking at the forward PE as well as comparing it to the sector overall. And for each one, we want to understand how have their historical metrics been, their free cash flows, the ROICs, sales growth, and many others. And as always, we're going to cover each one in terms of the valuation. What is our margin of safety? Do Wall Street see a lot of upside to get us excited? Now, before we jump straight in, we want to let you know earnings season is starting to kick off. Next week, we have a few big names. We have Micron Technology reporting after the market close on Wednesday, which may give us some insight into how the semiconductor industry is performing. We're going to see Accenture reporting before market open on Thursday, as well as the big name every retailer will have their eyes on. It is Costco reporting after market on Thursday. As always, we will cover this on the channel, so make sure you are subscribed. Also, as a reminder, this week was very big. We did get the 50 basis points. Not that everyone thought that is what we were going to get. There was a lot of talk about a 25 basis points just to ease us in. And in fact, we can see it is still sitting very, very high. The Fed do want to get this down to around 2%. And we should expect that over the next few months, this number will start to come down quite considerably. Now, before we take a look at the first company, we always like to look a little bit of data on this channel. And out of the last 14 rate cycles since 1929, so going back quite some distance, 12 of the 14 have in fact shown massive growth for the year after the first rate cut. Although if we do look at the more recent data, out of the last 3, we can notably see, in fact, the Great Recession, negative 17.6%. Now, this shouldn't influence whether you invest, what companies you invest in, but always nice to add a little bit of historical data into the mix. Now, the first one we're covering is PepsiCo, and we do get a double buy rating from Wall Street and Quant. We do note the hold from Seeking Alpha, and right now it is pretty much trading in the midpoint of the 52-week range. A nice forward yield, 3.1%, and we do also see a forward P of around 21. Bear in mind, for those that want to know, S&P right now sitting around 23. In terms of their performance, well, over the last year, they are down around 4%. Over the last 10 years, up around 88%, marginally underperforming the S&P during this time. And we can also see all-time highs around a year ago at just under $200. Now, when we take a look at their earnings from a historical perspective, they have outperformed over the last 4 quarters, 100% track record, and over the next 4, they are anticipating growth to the EPS year on year, and ultimately December 2025, if they hit their EPS target, the forward PE will sit around 19.56. Now, in terms of dividend safety, 93 very safe, always good to see. We also get an undervaluation signal based on this new model that we will cover, and nice to report the last growth from this company was in fact in February this year, 7.1%, well above that minimum 4% we target on this channel just to keep up in line with inflation. It was also reaffirmed the end of July, the very safe score, and ultimately what this means is that a dividend cut is highly unlikely. We also like to on this channel cover key metrics specifically relating to the last recession 07-09, and we do note PepsiCo in fact increased their dividend at that point. They had pretty much negative 0.5% sales, which was well above the average of the S&P at around negative 12, and we can in fact see they significantly outperformed the S&P, negative 35, S&P itself negative 55. We also quite like the consistency in the growth to their dividend, 7% over the last 5 years, and nice to report double digits, 11% year on year on average over the last 20. We've also started off this episode with a dividend king, 50 years or more of dividend increases, something that we do note from PepsiCo. And as we've said, a new valuation method today that we are using, we do get that undervaluation signal. And ultimately what this shows us is where the current price sits within the expected price based on the fair value. And when we zoom in over the last year, we can see pretty much for the majority of 2024 and the back end of 2023, this company has been trading right there below, in fact, the expected price. Now, we'll cover this in more detail when we do take a look at our own valuation model towards the end. We also note an undervaluation signal based on dividend yield theory, 3.17%, which is above the 5-year rolling of 2.82, as well as another undervaluation signal. The forward P of 20.3 is one of the lowest it has had over the last 5 years, the rolling average sitting there at 24. And when we take a look, it is higher though than the consumer staples sector of around 17.7. Now, in terms of looking at the metrics, the first one is the free cash flow payout, and we will just mention today that we don't look at the earnings on this channel. It is susceptible to manipulation by management through accounting, and while we do want to see below 60% as our main threshold, the consumer staples, if you want to be industry specific, we look at 70%. And what we do note, over the last few years, it has been pretty high. 2022, we would call this a red flag indicator, as ultimately it means management paid out more in dividends than they generated in free cash flow. Not something you see if you were to look at the earnings payout ratio. When we do, however, look at the more recent year, 86%, still high. Nice to note it has fallen from the previous year of triple digits, and also good to see over the next 12 months, this is anticipated to come down to around 73%, a lot more in line with that 70% threshold that we have. Then on the free cash flow per share, we want to see consistent increases over longer term. Not something we get with PepsiCo. It has marginally increased and a year-on-year basis, very inconsistent. Nice to report though, over the next 12 months, this is expected to increase, and by quite some distance. Then we get to the sales growth, where we look for 3 to 7%. This is pretty much for the more mature companies, which you could argue PepsiCo is. And the reason why we have the baseline of 3 to 4% is just to keep up in line with inflation. Otherwise, in real terms, if a company only increases 1 or 2%, it is actually decreasing. Nice to report, over the last 5 years, it has looked very, very strong. 6% in 23, 2% on a trailing 12-month basis, so maybe something to consider when we do look at their next quarterly report and the guidance they do want to give for the full year of FY24. Then we get to their total sales, where we can see pretty much around 40% growth to their top line, 67 billion to 92 in 2023. And while we do love it when companies do share buybacks, returning excess cash, we can see very minimal, very inconsistent from this company, so not something we would consider when analyzing this overall. Then we get to the ROIC. We love to see the consistency. Personally, 10% or more. Give us faith management are able to effectively allocate their capital. 12% for this industry. Very consistent, very high numbers. Makes it very attractive to potential investors. And one thing we always like to say on this channel is that we personally like to pay a little bit of a premium for when we do see that consistency right there across the metrics. Now, in terms of operating margin, yes, it is around that 16% that we want to see year on year, which is good. We have that consistency. One area that we have to mention is around operating efficiency. Ideally, we do want to see companies increase revenue as well as margins. Free cash flow margin, nothing really to say. Again, very strong, consistently around that minimum 7% level that we do target here. Then we get to the final metric, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 4 for consumer staples. Numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. And remember, quick reminder, this does correlate to dividend safety and balance sheet strength. Significantly below 4 year on year, in fact coming down from the highs of COVID, 2.66, 1.9 anticipated over the next 12 months. So balance sheet does look to be strong. Dividend also looks to be safe, as we saw. So overall, this does look like a high quality company. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they. Our intrinsic value of $196 today has come from these 3 models. Now when we do our deep dives, we do run through each one of these models in quite some detail, discussing inputs and outputs. Today we've got a lot to get through, so we're going to go straight into it. And at $196, we always like to use a margin of safety. Now we do start off with 10% and we execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for PepsiCo, well, you have a 10% MOS up to around $176. Then we keep going till it's near the current trading price. It isn't at the 15% level yet. You'd have to wait for around 167, but you could argue in today's episode between 10 to 15%. Again, for those that do want to know, at 20%, a buy at 157, at 25%, around 147. But as we said, today sitting between 10 to 15%. Wall Street, they do like this company. As we saw, it was a buy. It does have a nice yield over 3%, which will look more and more attractive as rates do get cut. 11% upside with their price target of $189. And as always, do give us your thoughts about these companies as we run through them today. We also want to let you know we have released our latest free weekly article. We send these out every single Monday where we cover what's happened in the market over the last week, as well as undervalued dividend stocks that we do believe deserve your attention. So do click below where you can sign up and read straight away for free. And we also have released 25 undervalued stocks for your consideration for the month of September, and we do run through each one, lots of information, what sits within our own portfolio as well. And this month we've also released 22 undervalued dividend stocks with the most upside according to Wall Street. So again, you can grab those two by signing up and clicking below. The next dividend stock we move on to is MSCI. Now we have a double buy rating where they hold from Quant. This one, similar to Pepsi, sits around the midpoint of the 52-week range with a yield of 1.15% and a forward P of 37. We note over the last year it is up around 3%, so very minimal movement, has underperformed the S&P over the last 12 months. But over the last 10 years, a massive outperformance, up more than 1,000%. Definitely a high quality company, as we are about to show. We also note over the next 4 quarters, 2 of them, they are anticipating double-digit growth, and nice to report, over the last 4 quarters, they have outperformed analyst targets. We can also see if they hit their EPS estimate for next year, that forward P will come down to around 32.85. Now, the dividend does look to be safe, score of 61. We have that undervaluation signal, and they do increase their dividend at a fairly good rate, 16% in the more recent in January this year. Again, this is a safe dividend score, so safe means dividend cut is unlikely. And when we look at the last recession, as we can see, no dividend, so no comparative data, but they had plus 1.5% recession sales, which was well above that average. Remember, it was negative. And we also note over the last 5 years, they have increased that dividend very rapidly, 24% year on year on average, whilst increasing the dividend for the last 9 years. Then we get onto that valuation where we can see an undervaluation, in fact fairly severe when you do look at the expected price, up to around $710, and very similar to PepsiCo over the last year. In fact, we can see for the majority it has been trading significantly lower than the expected intrinsic value. Then we move on to dividend yield theory, where we also get that signal there, both on the yield 1.16 above the 5-year rolling, as well as the forward P of 35 below 41.0. But interesting to note, it is sitting much higher than the financials as a sector at 12.2. Do bear in mind, if we were to go through each one of these companies that sit within this bucket, there are a significant amount of very poor companies, and we do ultimately believe that this company does deserve its premium. In terms of the free cash flow payout, well, below 60% is what we see every single year, 38 in the more recent year, 36 over the last 12 months, so no surprises why they are able to increase those dividends at a double-digit rate. And when we look at the free cash flow, this is ideally what we want to see from a model company, increasing consistently over the longer term, nearly 7 times growth in fact, and is expected to continue. So when you do look at companies and think, why do they trade at such a high valuation, take a look, because some of them are warranted. The main question you need to ask yourself is, how much of a premium should we be paying? In terms of sales growth as well, nearly double digit every single year, looking very strong. The last 3 years as well, looking very impressive. 15% as well on a trailing 12-month basis. And when we look at it from a numerical perspective, we can see around 2.5 times growth into 2023. On top of the very nice dividends, they have returned excess cash as well. We can see through those share buybacks, although not consistently, they do like to do, even if it's just a little bit every single year. Then we move on to the ROIC, no surprises, as we've already mentioned, high quality, already very high in 2014, 2015, and continues to increase. This is a strong sign of good management in place, 35% in 2023, 36% on a trailing 12-month basis. Then we get to the margins, again, very impressive. Remember, operating efficiency clearly shown by the increase on the margin year on year. And also remember, this is very, very high in the mid-50s over the last few years. Same to be said, very strong, very notable free cash flow machine in the 40s pretty much for the majority of the last 10. And then we get to the net debt to EBITDA. Whilst we would like to see this pretty much a lot lower than we see, nonetheless, below 3, 2.7 in 2023. Nice to report, 2.35 anticipated over the next 12 months. So overall, hopefully you will understand at this high level we've gone through today, this is a very, very strong and good quality company. Now our intrinsic value of $614, when we do run it through the MOS at 10%, a buy at 553, at 15%, not quite there yet. So again, similar to PepsiCo, sitting between a 10 to 15% MOS, and this is definitely one we would say to consider for the portfolio. It is a very high quality company, and as always, if you want us to do deeper dives into them, do let us know below. We also know Wall Street very bullish on this company, $620 price target, marginally higher than our intrinsic value, seeing upside of 14%. As always, let us know if these are companies you've been buying, maybe on the watch list, or in fact for some reason they're not one that fit within your own portfolio or investment thesis. We then move on to the luxury brands LVMH, where we get a buy rating from Seeky Alpha. This one is trading right there at its 52-week low. It is down around 15% over the last 12 months, although when we look over the last 10 years, this has still significantly outperformed the S&P, and we can see all-time highs sitting around last summer at around that $1,000 mark. In terms of a dividend, we can see the yield at 1.74% and a P on a trailing 12-month at just below 23. In terms of looking at this company, well, dividend growth has been very impressive, high single digit over the last full year, double digit of both the last 5 as well as the last 20. Then we take a look at this company in terms of their metrics, and the free cash flow has been below that 50% for the majority of the last 10 years, 61% in the more recent year, 54% on a trailing 12 month. So we would expect these very nice dividend increases to continue for LVMH. We also note the free cash flow, whilst inconsistent over the last few years due to the decreasing nature, over the longer term it has been increasing, and some large growth is anticipated over the next 12 months, which is always a good sign for shareholders, as well as in fact those who are potential shareholders themselves. Now, in terms of sales growth, well, nearly double digit every single year, 9% in 2023, although we do anticipate over the full year of 2024 to see this number reduce. When we have done reviews of their latest earnings, we can see there is quite a lot of weakness right across the luxury brand market, as well as weakness within China. We do, however, note in terms of total sales, it has nearly tripled over the last 10 years. Not too much really to note about these shares outstanding. In fact, over the last 10 years, they have bought back around 4 million shares, which is very small when you do compare it to the total figure of 500. In terms of ROIC, looking very strong consistently on a year-on-year basis, 21% over the last 2 years, so always a good sign to note. And we can see some operating efficiency, margins from 19% in 2014, now sitting at 26%, with the free cash flow margin itself above 5% every single year. Finally, the net debt to EBITDA, below 3 is what we want to see, below 3 is what we get, and from the highs of 2014, it has come down 1.67 in 23, expected to be there or thereabouts over the next 12 months. Now, in terms of LVMH and the valuation itself, we first want to point out Wall Street, again, very bullish, $891 price target. That is 34% upside. And we also note our intrinsic value is marginally higher at $914. Now, with the current price at $665, we do anticipate quite a large MOS. At 10%, a buy at 823. At 15%, a buy at 777. At 20%, a buy at 731. And we can in fact see in today's episode up to $686, you are getting at least a 25% MOS. Fully 30%, it isn't too far off. So today, as we can see, between 25 to 30% for what we do believe is a global brand. Also, there are a lot of positives with this company that we have covered in previous episodes, so do check that out if this is one that does interest you. We then move on to Waste Management, where we actually get our first triple buy rating right across the board. This one is trading in the mid to upper end of the 52-week range, a yield of 1.47%, a forward piece sitting around the 28 mark, and we note over the last 12 months up 28%, which has outperformed, although marginally, the S&P. We note over the longer term, it has significantly outperformed, up 331%. Remember, this doesn't include dividends reinvested, so if you were to incorporate that, it would be marginally higher. Then in terms of the earnings, how have they performed? We can see that over the last 4 quarters, they have in fact outperformed 3 of the 4 times, although the more recent was a miss, marginal, so 75% track record. Moving forwards, nice growth anticipated, 2 of the 4 double digits, and if they do hit that December 2025 EPS estimate, the forward P will come down to around 25.5. Now we can see a 74 safe dividend score, we have reasonable valuation which we can cover, and we note a nice increase of 7.1% in December last year. Now when we take a look at this company in terms of the last recession, well, they actually increased the dividend, pretty much average growth, and they also marginally outperformed the S&P, negative 40%. Dividend growth, nice to see for this company, 9% over the last year, and very large growth over the last 20. So if you have been a long-term holder, this would be one that you would like significantly. And we know 20 years of consecutive increases, which means they are 5 years away from becoming a dividend aristocrat. Now, in terms of the valuation based on the PE model here, we can in fact see when we zoom into the last year, it is trading around the midpoint of the expected intrinsic value. Remember, this is solely off this model and not one we do tend to look in pure isolation. In terms of dividend yield theory, we can see the current yield sitting at 1.47%, which is marginally lower than the 1.67, so you could argue reasonable valuation, with the 5-year average 27, again pretty much right there around that 5-year 27.3, although we can see in terms of the overall industrial sector, it does sit lower, 20.3, waste management trading at a premium, but as always, we do have to pay a premium for those that are higher quality. In terms of free cash flow payout, well, below 60% every year, bar the more recent, although marginal, and 56% over the next 12 months, anticipating we do believe the continued increases to those dividends will continue at a favourable rate to shareholders. Free cash flow per share, well, nearly doubled over the last 10 years, moving in the right direction, expected to continue, something we always like to see. And in terms of that sales growth, again, pretty much around the 3 to 7%. Some years significantly better. 2 out of the last 10 years have shown negative growth. Although when we do zoom out, look over the last 10 years, we can in fact see around 40 to 50% growth. And what they've also done, again, fairly marginal, but always nice to see, doing those share buybacks on a year-on-year basis, even if they are only a few million shares, always a nice little added bonus to investors. No issues with the ROIC whatsoever. In fact, every single year above the minimums, and from the lows of the COVID 2020 11%, it has been increasing 15% in 2023, 16% on a trailing 12-month basis. Margins, again, looking fairly impressive. We see small signs of marginal efficiencies, which is always nice to report. And the free cash flow margin, again, no worries whatsoever. This is a fairly consistent company, as we can see through the metrics. And we also like to see this net debt to EBITDA not only below 3 in 2023, but a nice drop anticipated over the next 12 months. Dividend looks secure, balance sheet also looks to be safe. In terms of the analysis of the price, well, our intrinsic value of $213 is lower than Wall Street. They are fairly bullish. Their price target of $230 does indicate 13% upside. And when we run it through the margin of safety in today's episode, at the 10% point, you would have to wait for around $192. At 5%, pretty much sitting where it is today. Now, this is a high quality company, which is why we have added it in today's episode. Definitely one we believe should be on your radar. Probably not an execution right now in the portfolio, but at 10%, a buy at 192 could be something to consider. At the 15% MOS, it could be one to seriously consider within the portfolio, especially if you don't already have this industry. Now, in terms of 20%, for those that want to know, it would be a buy around $170. But right now, 5% MOS, definitely something we believe should be on your radar, especially if the price continues to fall. We then move on to Chevron Corporation with a double buy signal and a hold from Quant, trading towards its 52-week lows. We have a yield of 4.5%, a forward P sitting just above 13, and we note over the last 12 months, down around 13%. Over the last 10 years, up around 19%. But remember, this will depend at which point you did invest. In fact, as we can see, COVID lows, this company was sitting around the $68 mark. So you would, in fact, be up more than double. When we take a look at their earnings, well, they have actually missed 2 of the last 4, notably the more recent at 45 cents, 50% track record. And as we can see, out of the next 4 quarters, only one signaling growth. Do remember this industry as a whole is very cyclical. That will be shown through the numbers. An EPS estimate of 13 will bring that forward P down to 11.1. But again, that is based on these numbers being hit and whether or not you believe management can do that, given they have missed, especially over the more recent period. We then look at dividend safety score, 90, very safe. We have that reasonable valuation, which we can dig into deeper, and a nice increase of 7.9% in February this year. Then when we take a look at how they've performed in the last recession, they increased the dividend, always a great sign to see. They had massive below average growth, negative 43, but they also significantly outperformed the S&P, -34. For a company that has been paying a dividend for a significant number of years, nice to report that their dividend increases not only very good, especially given the yield, but also significantly above that 3 to 4% of inflation that we target as a bare minimum. Now, they are a dividend aristocrat with 25 plus years or more of dividend increases, but they've also been paying a dividend for the last 112 years. This is a very good sign that this company does believe that dividend is very important to shareholders. Now, over the last 20 years, we see patches where it's been above, patches where it's been below the expected price. Over the last year, though, we can see, as well as right now, that it is trading right there towards the lower end of the expected fair value. In terms of dividend yield theory, the signal that we get here is an undervaluation on the yield, 4.48 above the 5-year rolling, although we can see that the 5-year average is pretty much in line with the forward PE for today, and we do note pretty much again around that sector PE for energy of 12.9. In terms of the free cash flow payout, well, we want to see below 40% for oil producers. We see around that over the last 3 years, 50% over the next 12 months, so we would expect these nice increases to continue at least above inflation, and the free cash flow also looks fairly impressive. Remember, the cyclical nature will sharpen these numbers, but over the last 3 years looking fairly strong, and a 30% increase anticipated over the next 12 months. In terms of sales growth, well, we can see here 6 of the last 10 years have been negative, 21-22 looking very strong, but not only negative in 23, but we can see on the trailing 12 month indicating to us that 2024 does look likely to be a very poor year solely based on the revenue. In terms of total sales, we can see the peaks and troughs of 192 down to the COVID lows of 94 up to 195 in 2023. They've done everything. They've done share buybacks, they've done share issuances, 1.9 to 1.87, round to 1.86 right now. So don't really factor this in when you are coming to your own conclusion and thinking about this in terms of your own portfolio. ROIC as well, looking fairly decent considering 8% for oil producers over the last 3 years. Trailing 12 month also showing strength in this metric, sitting right there at the 12%. And when we look at both margins, operating as well as free cash flow, last 3 years have been fairly favorable for Chevron, something that based on the trailing 12-month basis, we do expect to continue into 2024 and 2025. Then we look at the net debt to EBITDA. This is very good to report, given we've got the very safe dividend score. No surprises here. Last 3 years looking very good. Over the next 12 months as well at 0.45. Indicating again, no worries with that balance sheet, but maybe just something to consider given how cyclical the nature of this industry is as a whole. We then get to our intrinsic value of $173. Now do remember as well, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Chevron or any other company. Margin of safety, 10%, well, a buy at 155, 15% a buy at 146, which is pretty much where it sits right now. So if you are looking at this company, we see around a 15% MOS. With Wall Street, very bullish, 23% upside, their price target 179, deeming if you are into companies that do pay a very nice yield with nice increases year on year, as well as some nice gain, then Chevron Corporation could definitely be one for you to consider in the portfolio. But as always, do let us know whether or not you agree in the comments below. Continuing the theme of nice dividend yields, we have Pfizer with a yield of 5.66%. We get a double buy rating and a hold from Quant. This one we see the forward P sitting just over 11, trading in the mid to lower end of the 52-week range, down around 12% over the last 10 years, pretty much flat. We can see that COVID peak sitting around the $59 mark. In terms of their earnings, well, always good to see. Last 4 quarters, 100% track record of beating. Over the next 4, lots of inconsistency, and if they do hit December 2025, forward P coming down to 10.3. Nice to see for a company with a strong yield that the dividend does look to be safe. We have a reasonable valuation, and one thing that we would like to see a little bit better of this company are those dividend increases, 2.4% in December last year. In terms of the last recession, well, bear in mind if you see one looming, they did cut 07-09. They had marginally above average growth and also marginal outperformance at negative 45%. Nice to report, whilst the increase was fairly poor last year, over both the last 5 years as well as the last 20 years, this company has been increasing those dividends at a bare minimum around the inflationary level, and we do note 13 years of consecutively increasing that dividend. In terms of the valuation then, over the last 20 years, we do see quite a significant number of years trading well below its fair value. Over the last year though, we are seeing it within the bucket, although towards the lower end. Then when we take a look at dividend yield theory, we actually get a massive undervaluation signal on yield, 5.71, well above the 4.04, and we do note the forward PE marginally lower at 11.3 than the 5-year average, and we can see as well pretty much a triple undervaluation signal today, as Pfizer does sit massively below the healthcare sector of 16.8. Then when we look at the free cash flow payout, as we mentioned before on this channel, triple digits essentially meaning a red flag indicator as management paid out more in dividends than they generated in free cash flow. Nice thing to note, it is expected to come down massively over the next 12 months. So hopefully this December we can see at a bare minimum an inflationary level increase. In terms of free cash flow per share, no surprises for those that have been following this company. COVID was very, very strong for this company. We'll see that throughout the numbers, but since then it has come down quite significantly. Given a lot of acquisitions they have done as well as organic growth, the next 12 months is expected to be very, very strong. In terms of sales growth, as we said, previous to COVID, it wasn't looking that great. COVID then happened, their numbers shot up very strongly. Since then, negative 42% drop, and that is again shown through those numbers on a numerical basis. What they have done over the last 10 years, which has been positive, is returning excess cash, buying back nearly 1 billion worth of shares, although we can in fact see from 2020 they have done the opposite, started to dilute your position, and then in the more recent year done the opposite and go back to those share buybacks. ROIC not looking great in 2023 at 3%, something to keep an eye on because previous to that it was looking good, although fairly inconsistent. 2% on a trailing 12 month, again, something just to consider and maybe a reason why you could perhaps increase your margin of safety. Again, similar to what we just discussed, the more recent year hasn't looked the greatest in terms of the margins. In fact, from 2018, there was some massive operating efficiency, up to 39%. So a little bit worrying, not only it's decreased in 23, but also a decrease on a trailing 12-month basis. Again, same to be said for the free cash flow, although even with the drop in the more recent year, it is still above that minimum 5% level. We then get to the net debt to EBITDA. Below 3 is what we want, above 3 in 2023, but expected to come down over the next 12 months. Probably the reason why we see a safe dividend score as opposed to the very safe that maybe some people do like to see. Then we get to the actual valuation. Now our intrinsic value of $35, not too far off Wall Street of 34. They see 16% upside. And when we do run it through the MOS at the 10% level, a buy at 31.37, at 15% around 29.63. So right now you're getting 15% margin of safety. You're getting nice upside at 16%. And the yield is also very attractive. As we've mentioned before, with rate cuts, a lot of consumers who had money on the sidelines in their savings accounts getting favorable rates will now start to move back into the market, into companies where they do have those high attractive yields. Companies like Pfizer could definitely be one of those, so something to consider within your own investment analysis. Again, we continue the very favorable dividend rates here, 6.12% for UGI with a double buy and a hold from Quant. This one is trading in the mid to upper end of the 52-week range with a forward P sitting just above 8, and over the last 12 months, not great, negative 3% performance. Over the last 10 years, as we can see, negative 29%. In terms of how they've performed, well, always good to see 100% track record over the last 4 quarters. Again, inconsistency on a quarter-by-quarter basis, purely on those expectations, but that is something we have come to expect with cyclical companies, and forward P in 2025 September is anticipated to be pretty much bang on 8. In terms of dividend safety, well, a score of 60 borderline safe, an undervaluation signal, and we are still waiting for their increase from the previous year. So how does this company look in the last recession? Well, what we do note, they increased the dividend, great sign to see. Average growth, negative 16%, and massively outperformed the S&P, negative 16 versus the S&P's negative 55. They've also increased the dividend fairly favorably, 8% over the last 5 years, 7% over the last 20. Always impressive for companies that already pay a very attractive dividend. And not only are they a dividend aristocrat, but they have been paying a dividend for 139 years without a reduction. In fact, that is higher than Chevron that we just covered earlier today. Then when we take a look at the valuation based on the forward P, in fact, pretty much over the last few years, this company has been trading significantly below its fair value. Over the last year, we can see that massive difference. So again, something to consider and something we will look at in our valuation. We also get a massive double undervaluation signal. This yield is significantly higher than the 5-year of 3.83 and the forward PE significantly lower at 8 versus 12.3 and lower than utilities of 17.9. So a massive triple undervaluation signal for UGI today. Then we get to the payout ratio. Bear in mind, given this is a utility company, because it is a lot more volatile, we will draw your attention to the earnings payout. Below 75% is what we want. That is what we get every single year. Pretty consistent around the 40 to 50% point and 50% expected over the next 12 months. Then when we look at the earnings per share, similar to free cash flow, we want to see growth over longer term. It is what we like to see actually. Considering this a utility company, we have to have realistic expectations in line with what we would expect over other companies in the sector, and nice to report growth anticipated over the next 12 months. Then when we look at sales growth, no surprises here given the cyclicality that we mentioned. 5 of the last 10 years have been negative, notably the more recent year of 2023, and that is why we do get a lot of inconsistency, a lot of peaks and troughs over a 10-year period. Also understand that given this is a utility company, we do anticipate that they will dilute your position over the longer term, something we can clearly see, although not at a very massive rate. So always nice to note, especially for companies that we do expect that in terms of comparing to the sector, they are one of the lower ones. ROIC 7.5% for this industry over the last 10 years. That is pretty much what we get, so that is nice to report. Although the more recent year, -5%, not something we want to see. As in fact, when we do look at the margins, this does show us that for 2023, they did report a loss. But previous to that, it has been pretty much straddling around that on a year-on-year basis. What is nice to report on a trailing 12-month basis, 18% does seem to be the figure. So it does mean hopefully for 2024, they will go back to turning a profit, something we have seen consistently from UGI. Then when we get to the net debt to EBITDA, below 5.5 for utilities, actually significantly below that over the last 10 years, bar 2019, 4.17 in 23, 3.66 expected over the next 12 months. So lots of positives with this company, and when we do draw your attention to the valuation, we can already see Wall Street bullish, 29% upside, which is always great to see for a company that has a very high yield, and impressive for a company that does increase its dividend at a very favorable rate above inflation. Given our intrinsic value of 35.88, with the MOS at 10%, a buy at 32, and then we keep going, and what we can in fact see in today's episode, you are getting at least a 30% MOS, not quite at the 35%, so somewhere between 30-35, with Wall Street, as we can see here, indicating this for some serious consideration in your portfolio. We then get to the semiconductor giant ASML. Now we get one buy rating from Wall Street, 4.34 out of 5. That is fairly strong, with a double hold from seeking out from Quant. This one is trading in the mid to lower end of the 52-week range, with a yield of 0.8% and a forward PE sitting around 37.9. Over the last year, they have outperformed the S&P, up 35%. Over the last 10 years, a significant outperformance, up 727. Then we look over the last 4 quarters, they have outperformed by quite some distance each quarter. That is a very good sign. And over the next 4 quarters, we are seeing some massive growth of the EPS expected. And ultimately, if they do hit that in 2025, the forward PE will come down to around 24.2. In terms of dividend safety, well, 82, very safe. We get that undervaluation signal with a fairly mediocre increase just over the last few months. As we will show you, they have been increasing this dividend at a very strong rate historically. Now, they did cut the dividend in the last recession. They did have below average growth, and they pretty much had a near S&P return, -55. As we said, historically, they have been increasing these dividends at a very, very phenomenal rate, but just disappointing in July this year, it was around 4.8. We also note they've been increasing those dividends for the last 14 years. And when we do look at this valuation, what we can see specifically to over the last year, this company pretty much for the first time, in fact, in 2024, has been trading right there below the range of the fair value. In terms of dividend yield theory, we actually get a reasonable valuation on the yield, pretty much in line with the 5-year average, although we do note it is trading significantly lower in terms of a forward P, 28.9 versus 34.1, but it is trading a little bit higher than the information technology sector as a whole of 25.5. Remember, some companies do deserve a premium, just question remains, what premium is it that you should be paying? For semiconductors, we want below 50% in terms of the free cash flow payout. We noticed it got fairly high in 2023, makes sense why we got that mediocre increase, but nice to report over the next 12 months, expected to come down to 14%, so I wouldn't be surprised if we do get a double-digit increase in 2025. In terms of the free cash flow per share, it has increased over longer term. We do get the inconsistency. Bear in mind, this is also a cyclical industry. Nice report, more than double increase anticipated the free cash flow over the next 12 months. In terms of sales growth, well, as we can see here, double digit nearly every single year. Trading 12 month, there is some weakness anticipated, but when we have looked at their quarterly earnings, they do expect a very, very strong 2025. From a numerical standpoint, looking good, 6 billion in 2014, up to 28 in 2023. And what they also do, again on a fairly inconsistent basis, are share buybacks, which is an added bonus, especially if you have been a long-term shareholder, getting use of those very nice dividend increases we have seen over the longer term. In terms of ROIC, not only very strong and not only increasing over the period, but in the mid to upper 40s over the last 3 years. That is very, very strong. Not something we do see a lot on this channel in terms of hitting those numbers. And when we take a look at their margins, consistently above the semiconductor average, 33% in 2023, and free cash flow margin looking very strong, very healthy on a very consistent basis. We then get to the net debt to EBITDA, the best one we have seen in today's episode, 0 right across the board. What this signals to us, it wouldn't even take ASML 1 day to pay off all of their debt net of cash on hand. Now let's jump into the valuation model. In today's episode, we are just using the DCF model, getting to 1152, and we will show you how we got to this metric. We have the DCF model where we have the free cash flow year on year, average growth 35%, which is very impressive, and we have gone for 3 different rates moving forwards, 25, 30, 35. Now we've got 30% here. Based on the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, massive undervaluation, in fact signaling 31% upside. Now this is very subjective and you can run your own numbers through. By clicking on the pinned comment below, you can grab a copy of this model, and whether or not you want to look at ASML or any others that you do wish in your portfolio or on your watch list. For full transparency though, we will look at the other numbers. So at 25% we get 831, which still signals upside of around 4%, but not far off the current value. For those that believe it should be higher and in line with the 10-year, we see 35%, 1584, and that is 50% upside. Now taking through 30% to the final slide, what we have here is 1152, and as always for that consistency we run it through the MOS, 10% a buy at 1037, 20% around 921, 30% around 806, which is around the current trading price. It isn't at a 30% MOS, that would be around $750, but you are getting at least a 30% margin of safety with ASML in today's episode. And as we can clearly see here, Wall Street very bullish. They have 48% over the next year, which is very strong for a company which does look to be high quality, and their price target 1173, not far off our intrinsic value. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter where we are dropping our next copy on Monday. And as always, come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.